Ooh, baby, we're starting off with a hot one here. Alphabet, as in Google, as you might know it, reported some earnings here. And look at this bad boy at 4% after hours. Not a massive move, all things considered, because today, during the regular session, it was down 3%. So if you think about it, really up 1% for the day. But we're still obviously in relatively new after hours trading right now, right around 4 o'clock. So we'll see what happens at open tomorrow, but this is going to be released today. So 4% after hours. Let's take a look at these earnings and see what we have. Alphabet non-GAAP missed by 89 cents. Oh gosh. GAAP EPS $9.87 as well. So it seems like the same metric that they're doing here, which is interesting because the estimates were a little bit different. Missed by 34 cents on a GAAP EPS standpoint, which is one I care about more than I do the non-GAAP personally. But you see from a revenue perspective, up 13.3% year over year, beats by $1 billion. Let's just round that up. Come on. Let's not say $999 million. Even though I just said it, but we're rounding that up to beats by $1 billion. Big beat in terms of revenue. Now, my question here, my quandary is going to be in what in the world happened with this EPS line? Because that's a pretty ugly miss on the EPS perspective. The 34 cents isn't awful when you talk about how much this company makes in terms of EPS, but it's not pretty. Not a pretty miss, that's for sure. So we're gonna take a look at some of this info and see what we can have here. So Alphabet up after growing EPS and easily topping revenue expectations in the first quarter. Heavily watched for signs of potential ad weakness. Ad revenue did decline on YouTube by 14% from the prior quarter, though it is up 33%, 33.5% year over year. So, as video distributors face an industry-wide advertising slump. So we talk about an advertising slump and ad rates, but they saw a 33% year-over-year growth, actually, in terms of ads, specifically on the YouTube platform. So, decline of 14% from the prior quarter is not unexpected at all. If you think about quarter one for these tech companies, it's how it goes for retail companies too. Q1's usually the slowest quarter for them in terms of revenue, the lightest, and then they see a rise, and Q4 is always the biggest for them. It just always is. More people on vacations, more people have more time on their hands. It's just how it goes. People view more things in Q4 of these companies. So the fact that Q1 was down from the previous quarter is 100% normal. That's not odd at all. In fact, if you looked at, let's just show you here. I want to show you exactly what's going on here. Let's just blow your mind here. Oh, what a shocker! Q4 is the biggest quarter, and then it goes down. Look at this. Look at this. All right. My point's been proven. I'll just tell you that right now. Q4 is always the biggest quarter, so you expect a decline. Every single year it's been that way, so I don't know why they needed to include that. Sorry, I don't mean to get on a tangent, but it's just fact. Performance was strong during the quarter, or during the first 2 months of the quarter, but then in March, we experienced a significant slowdown in ad revenues. Still was good. Overall revenue rose 13% versus an expected $40.2 billion. It was up 15% on a constant currency basis. Operating income rose 19% to $7.98 billion. Operating margin dipped to 19% from a year ago's 23%. Net income rose to $6.84 billion from a year ago, which was 6.6 on a GAAP basis. So that's honestly really good. Again, their EPS missed, but clearly you can tell from this, it was the expectations that must have been very high. Obviously, their estimates were very high because they actually did grow in terms of profit. So that was honestly good. If you see profit growth here, especially during what's going on, honestly, all hats off to them. They've done a good job in terms of that. So very good growth there in terms of net income. So that doesn't really concern me that much. From the revenue breakdown, you see Google Search was $24 billion of the makeup there, so a little over half. Up 8% year over year, 8.7. YouTube up 33% year over year, big stuff. YouTube adds $4 billion in that. Google Network member properties, $5.22 billion, up 4%. Google Cloud up 52%. Again, cloud business is massive right now. Cloud is how companies really grow a lot. And their cloud business overall, pretty small compared to the main portion of their business. So they can grow that quite a bit. Others up 4.44%, up 22.5% year over year, or 4.44 billion, I should say, for others, and other bets, not even relevant. So we don't have a presentation for them, but we will look at their quarterly release here. Take a look at this and see what they have to show here. So obviously you see from the revenue here, last year they grew their revenue 17% year over year. This year, in this quarter, 13% year over year. Nothing massive there. I mean, nothing's too crazy on that standout. Operating margin, similar to last year in terms of GAAP basis. On non-GAAP, it's definitely a little bit different, but overall, you see this operating income difference. Pretty massive difference between the two year over year. Difference of $1.3 billion. I mean, that's quite a bit. But you see from a non-GAAP perspective, I don't know necessarily what they're adding into that on the non-GAAP perspective, but clearly their non-GAAP used to be different from their GAAP, and now their GAAP and non-GAAP must be the same. I'm guessing they just changed those metrics. You see they're the exact same in terms of operating income. So, yeah, nothing crazy. Other income actually was a negative this year versus a 1.3 billion. Or other, income expenses, I should say. So, not sure exactly what's adding into that, but again, that's a big portion for that operating income difference, you could tell. Exciting stuff. So, you see the difference in YouTube ads, 3 billion versus 4 billion. Big stuff, big growth there. Google search, a difference of $2 billion year over year. Pretty massive. So, pretty massive. So from a operating income perspective, you see a good difference here. We'll take that, okay? That's, really all things considered only $100 million, but that's a lot of money. $100 million is not a small chunk of change. For a company like this, maybe, but in terms of profit, $100 million profit, oh, golly, we'll take that. The only other thing I'd like to look at is the balance sheet on this to see what's going on with this company. Current assets right now in this company, as of this most recent quarter, actually increased year over year. So right now they have quite a bit more in terms of cash, $1 billion more in cash. But overall, the marketable securities are down. So nothing too crazy. But total current assets, you see a $5 billion decrease year over year. Nothing too wild. But from a total asset perspective, you're only down $2 billion. But look at this: total current assets, or total assets in general, in this company of $273 billion. Holy crap! Talk about freaking money. What is going on? Look at this. I'll just tell you this right now. Total liabilities on this company right now, which they paid down debt, which is why they have less cash. Total liabilities of $69.7 billion. That's versus the total assets of $273 billion. You're telling me right now that their cash position is 4 times as great, or their total assets position is 4 times bigger than their liabilities. That is incredible. And that's why when you face times like these, companies like Google are the ones that you run to because they're safe. A company like this with $270 billion in assets, trust me, they're not afraid of this right now. They're in no danger. This is crazy. The amount of money this company prints is good. This company prints money like no other. That's just a jarring line right there. And if you think about this company, obviously you look at the share price and you're like, what the crap? Obviously, with a lot of companies offering a partial share, stuff like this, for this company trading at a PE ratio right now of 25, we're going to look, obviously, last thing I want to look at is the forward PE of this company, because it might make you think a little something. Forward PE of 31 right now, trading a little bit higher because obviously the EPS estimates have gone a little bit down due to this. But for a company that has so much cash on hand, Yikes, that's not bad at all. That's not a bad PE ratio at all for someone that has such a strong balance sheet. So, and its company's still growing pretty massively. 13% isn't as wonderful as some companies might be growing. I mean, companies like Facebook are making similar revenues but growing, in the 20 to 30% range. But overall, 13% year-over-year growth at billions of dollars when you're in the tens of billions is massive. This company is very good. I don't think the share price is unfair right now, in my opinion. Obviously, with this recent raise, you'll see a little bit of difference in the P ratio. I think there's a very fair valuation on this company. They're doing a lot, and they'll be fine through this. So I think people could flock their money to this type of company because the balance sheet's so beautiful. Shoot, I like what's going on with this company. Let me tell you. If we look historically, we'll just look obviously year to date. This company's been hit pretty hard. So if we're talking since this dip down, since their highs in February, this company's down nearly 19%, which is more than the market. So I think this company's got very good potential here. I don't think it's a nightmare. Again, we have issues. People are kind of pricing in the effect of a potential slowed ad rates in the near term. I think they will absolutely recover in Q3, but Q2 could be a rough one. That's what we're going to look at for this company. So overall, I like what's going on.